Hello, everybody. Welcome. As I like to do every week, we like to take a look at the past week's market activity and then, of course, bounce around the market and look for something to trade. Well, I know I sound like a broken record because this has kind of been our trend for the last 6 months or so, basically up, 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 and away. We'll see if anything changes in the next few weeks with the Fed talks and all that stuff. Maybe the market gets a little bit more volatile. But for the most part, except for a couple of dips here and there, you can see it always seemed to recover, and it's been kind of on a steady rise upwards, which means, as I mentioned always, that the volatility is obviously pretty low in the market. You can see down here it's only at a 5. I have the same thing up here. And this is the S&P 500. This is where I always start. This is, for me, the actual market. The S&P 500 and the NASDAQ, to me, are the entire market. The Russell is the small cap stocks. This is the NASDAQ. Look, very similar picture. Looks exactly the same, right? IV is 7 instead of 5. Russell is also looking exactly the same, except now this one has kind of caught up and it's at all-time highs. It seems to be outperforming the other two, but essentially the same looking graph all the way around. So, what are we going to trade this week? We're going to go over to HPE, which is Hewlett Packard. They've already had earnings, so that part is done. And you can see after earnings it shot up, and this has been on a steady rise as well. Volatility, although compared to where it's been over the last 6 months, is low, overall compared to everything else in the market is very high. 33 is still decent. So we're always looking for volatility if we can find it. This is still fairly volatile stock compared to the market, as you saw, which is 5, 7, 8. So what are we going to do? Well, being a contrarian, what I'm going to say is, well, this thing has gone up steadily for the last month or so post earnings. My bet over the next few weeks is going to be, I'm going to say maybe it goes up, but over the next 45 days-ish or so, I'm going to expect it to kind of top out and hopefully start to slide back down a bit. Purely my assumption. You might have the opposite assumption. You might think it's going to continue up if you're a trend trader. Being a contrarian, I go the other way. That's why there's a market. People have differing opinions. Nobody knows the future, but we have to make an assumption before we make a trade. And in this particular case, I think it's had a pretty good run. My assumption is going to slow down and hopefully turn around a bit over the next 40-ish days. So with that assumption, we'll go to the trade page. Now, normally you'd say, okay, I'll use these ones, 47 days, because that'll be 46 tomorrow, which is right in our wheelhouse. But when I open this up, I want you to see how illiquid these are. Look at these numbers, 0 to 125, right? 70 to 144. This is liquidity. The bid-ask spread is what we're always looking for. So this is untradeable. But if I go to the monthly expiration cycle, and the monthlies are these white ones here, these are always, always, always going to be more liquid than the weeklies. So if I open these up, different story. Now look, 5 cents wide, right? 5 cents wide. See the difference? That's liquidity. We want these numbers to be as close to each other as possible. That means we're getting the best possible fill on our trade, which makes it much easier to make money. If there's a big wide bid-ask spread, then we're probably losing money getting in and we're probably losing money getting out. So when these numbers are close, just as a general rule, the smaller the gap between these two, the better it is for us as traders. So my assumption was that I think over the next 40-ish days, because this is the expiration cycle we're going to use, it may go up for a little while, but over the next 40, I expect it to come back down. So the way I set that up is I want to sell a call vertical. So what I do is I go right above the stock price, which is 24. You can see right here at 23.52. And I'm going to sell the 24 call and buy the 25 call to create that vertical, the sold call vertical. And as long as I collect 33 to 40 cents per $1 in width, which is our rules, this is a valid trade. So, assuming everything stays the same, tomorrow when the market opens, we're going to go right to the 24 call and sell it, buy the 25 call. This is a small trade. It's just a $1 wide trade. So if I collect 36 cents, that means the most I can lose is 64. And that is, again, using my assumption of a contrarian. I believe the stock will start to slow down and turn around over the next 40-ish days. That's the trade or the bet I'm making with this sold call vertical trade. And that is our trade in HPE for tomorrow. Hello everybody, just a quick break in action here to make you all aware of the courses I have available on Udemy, which are these 5, but more importantly to let you know that these 3 right here are a 3-part series. So if you're anywhere in the mix here, now you know that Understand Options Completely is part 1, Basic Option Strategies is part 2, and Make and Manage is part 3. So you can start or continue at any level you like. The bottom 2 here can be taken at any time. They are just independent courses. If they interest you, please go ahead and take them. So you've got some knowledge now, and we know knowledge is power. But really, knowledge is only power if you use it. Otherwise, it's useless. So how do you take all this option trading knowledge and turn it into actual income? And the only way to do that is by actually trading options. As someone that's gone through the process, I know that making real trades is scary for many reasons, not the least of which is, where do I even start? I mean, there's so many roadblocks to making trades. What stock should I trade? What direction should I choose? Which options am I buying or selling? The list seems endless, which is exactly why I created my option income alert system. So don't you think you'd be a little bit more comfortable and confident if I was right there by your side making trades with you? Where now I will be there with my real-time alerts. You'll trade side by side with me in real time as I tell you what trade to make, why we're making the trade, and more importantly, how to make the trade correctly. But making the trade's only half the battle. When to close the trade is just as important, so you'll get those closing alerts as well. Listen, you've got the knowledge now, so let's put it to use. So how do we turn your knowledge into actual income with as little risk as possible? Well, the way we do that is by offering up the option alert for only $1 for the first month. Now, the option alert itself is going to send out 2 to 3 trades in real time as I make them via text or email directly to you. And as I close these trades, you'll also get those closing alerts in real time as well. Now, if you want an even better opportunity, the Option Pro, which is the exact same alert service as the Option Income, offers up all the content I've ever made, courses, webinars, etc. Over $2,000 worth of options courses for only $19 for the first month. So the way we're going to sign up for either of these is by going to sharpertrades.com, clicking on the products section. Both of these alerts will show up. Depending on which one you prefer, you'll type in these coupon codes and you'll either get the option alert for $1 for the first month or the Option Pro for only $19 for the first month. Look forward to seeing you all over there soon. Take care.